So how can I help you help your kids get wealth up? I've often struggled with the whole RESP world in which we live. Let's elaborate on what an RESP is and what I think is not working in the RESP. I will start by saying I am a bit anti-RESP. It's a great program if it works, but it could also not work, is kind of the problem I have. So I just want to go over a little bit about what it is and why I don't like it and what alternative I've sought because of that. All right, so an RESP is Registered Education Savings Program, and it's basically the government's way of saying, hey, look, we know that the kids are our future. We have to invest in our future. We need to ensure that our children have an opportunity to go to university or post-secondary education and make something of themselves. But they are leaders of our future. We have to invest in that. Totally fine. It created a vehicle, RESP, which is a way to help parents, grandparents, someone in the family get behind saving. The way that they influence saving is they offer a 20% matching of an annual deposit made. So if you put in, the max is $2,500 a year, they'll give you $500 a year in a grant. Together, your $3,000. It's invested towards something. Towards something is kind of the issue here. Some investments do well, some don't do well. And that impacts the results of savings program. On top of that, when you analyze how much money it actually costs to go to university, if you're starting today and your kid's going in 18 years or 19 years, it's a big cost when you do the math. Like, I've been online looking at calculators, trying to assess what is 4 years of university like if this kid wants to go to university away from home, room and board, tuition, all that kind of stuff. And some of these numbers are coming back conservatively well over $100,000 for 4 years. As somebody who has RESPs set up for my kids, I'm not on track. And they were in some growth portfolios at the recommendation of a financial planner who, that's what they said. This is, trust me, nowhere near. Anyways, it will not fund university, but it'll help fund a portion of it. So if you go in with that mentality, you won't be disappointed. I don't think it's sold that way. I think it's definitely sold as mainstream. Put your money in an RESP, you're solved. So I've not met anybody who has successfully funded 4 years university for their kid going away, actually setting this up. I've not met anybody whose RESP provided that solution. There was always more that was required. Having said that, I have chosen to make a change in the way that I fund for my kids. And it's not just university now. I'm talking, it goes beyond there. One of the RESP issues I have is if the child does not go to university or a qualified secondary program, which I think more and more is becoming a reality. I don't know that it's mandatory to go to university at the moment. If your child does not go to university or does not survive to get to the point where they can go to university, well, there are complications in getting the money out. A financial planner might tell you that it is pretty easy if you have room, or it's not easy. You can transfer some of your funds to your RSP if you have room. And if you want to, I prefer liquidity of controlling my own money outside of a registered plan that gives me rule after rule after rule on what I can do with the money, when I can access it, all that stuff. So I approached someone on my team and I said, here's what I'm after. I'd like to consider a savings account that will be a lot stronger and will provide a lot more flexibility for my kids. Here's what we came back with. The solution is baked in life insurance for me. Here's an example. This is an actual example of a policy that I've started for my little kid, actually. And it'll act as a savings account, a growth account, and it'll provide insurance, which is super beneficial. All right, so what I decided was, instead of paying $2,500 a year to her RESP, I'm putting $5,000 a year towards a life insurance policy. Bear with me. The policy itself is broken up into two parts. There's a required premium, which is this number right here. And then there is additional option. My requirement is still under $2,500. However, I can choose to put in up to $5,000. The annual payment that'll be made towards this, and it's definitely giving me peace of mind and a death benefit for my kid. No parent wants to think about the mortality of their children, but the truth is we are all mortal. We all will pass at some point, including, unfortunately, my daughter. And right now, she's got a death benefit associated with this. The last thing I would want for her as somebody who is well insured is she becomes an adult and something happens to her as she's aging, as she's growing, and she's going through puberty and maturing, and something's going on, affects her ability to get insurance going forward, and she's no longer insurable. I solved that problem right now for her. She will never have to qualify for insurance because she'll always have insurance now. This is a permanent policy. So $5,000 goes in here, and it's the first $2,300 is going towards a requirement, and I've made the decision to put an additional amount of insurance, which is essentially buying more insurance. Her insurance death benefit started off at $310,000. It's actually going to be $350,000 after the first year because of the extra $2,700 that I put in. That's great. The insurance need is solved. It wasn't really a big need, but it's definitely an insurance need, and that's solved. Here's what really happens. We're going to contribute $5,000 a year for several years, forever. Look what happens. 5,000, 5,000. So it's 15,000, 20,000. At 20,000, and after 4 years, she's contributed 20,000. At the 5 years, she contributed 25,000. And she has a buyout, a cash value of her policy of 26,378. At this point in year 5 and forever going forward, every dollar that goes into this contract is going to generate more than $1 in cash value that I can access for whatever reasons I want as a loan, including paying for university, for example. I can either wrap this contract up or I can borrow money against this policy. It's pretty cool. Check this out. Every year we're putting in $5,000. In between the third and the fourth year, that account value with that $5,000 deposit actually increases more than $5,000. In this case, it's over $6,000. Insurance policies are structured like this. This is what happens when you have a well-designed insurance policy with growth in mind. Defense is covered. You've got the death benefit covered. Now this is going on offense. And offense is saying this: I'm putting in $5,000 a year, every year. In the fourth year, my $5,000 is going to increase the value of my contract by over $6,000. The next year, it'll go up even higher. And every single year beyond there, the $5,000 contribution that I'm making is going to increase the value of that policy by more than that $5,000. That's crazy. It's amazing. Let's say she's 30 years old. She's mature, she's responsible, and I am ready to let go of this contract. She's ready to buy her first place or something. I can hand this policy over to her. She will have access to $156,000 in cash value, assuming these dividends continue or the growth rate continues. She'll have access to over 150 grand. She doesn't need anyone's permission. She can request a policy loan from this policy and it will not stop its growth. She has access to 150 grand. She can go put that as a down payment somewhere or buy something. Forever from this point forward, she can hang on to this policy, put in $5,000 and generate more than $5,000. Look what happens at year 20 to 21. She puts in $5,000 and it goes up $13,000 in value. Every year, it'll get bigger and bigger and bigger. This is leaving a legacy. If I just set up an RESP and just did it for university, I will save up, I will deplete that account's over. All the savings of all those years, paid for that one thing, and that was it. It's over. Doing it this way allows me to have access to funds for her, for a death benefit, for insurance. It allows me to access money to borrow for university if I want to. Why not? When she's 18 years old here, I will have access to $45,000 right there. Now, if I borrow it, I got to repay it. I should. So that's a responsible thing to do. I don't actually have to. $45,000 is an available cash that I don't need anyone's permission. I can borrow 10 at a time, whatever I need to satisfy her goals for post-secondary university. And if she doesn't go to university or chooses not to go down that path, great. I still have an account value that I don't need to destroy like I would in an RESP. I can continue to build this up. This is an excellent present to give to my kid as a legacy on the way out and say, hey, here you go, kiddo. I've saved this money for you all these years. This is yours now. go take care of it, be responsible, and use it as you see fit. As she ages, check this out. What started off as $310,000 in death benefit, when she's 50 years old, $5,000 every year brings her, in this case here, check this out, 35 grand. 5 brings her 35 grand. The benefits of this policy: guaranteed insurability as she ages, guaranteed flexibility in how I want to interact with this. I'm not depleting the account, compounding and financial energy that's going into this. I'm not doing any of that stuff when she goes to university. It's going to happen regardless. It's going to be perfect for this. And I get to give my kid actual legacy. She in turn could do the same for her children, the same way. This is generating momentum and it never ends. It just so happens that all of this exists within a single package called a participating whole life insurance policy. These are my numbers. They don't need to be your numbers, but it's certainly worth a discussion to see if this is something that could work for you and your children. Get wealthed up.